Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Good morning, everybody. It's me. It's Herb Morgan. It is, Monday, May 6, 2024. I'm Senior Managing Director and Chief Investment Officer of the Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary, otherwise known as Slaying Bulls and Bears. The presentation you are seeing or hearing is prepared by Cantor Fitzgerald Investment Advisors, LP, for use with investors and their financial advisors. But of course, each are expected to make their own investment decisions. Nothing contained in this presentation should be treated as investment advice. No recommendations are being made for the purchase or sale of any securities. Everything is purely for informational purposes, and its accuracy, adequacy, and completeness cannot be guaranteed. Well, let's get into last week. We had a good week, solid week. S&P 500 up 0.5%. But you know how I've been talking about leadership of large companies, particularly large cap tech, which is the S&P 500 now. When I started in 30 some odd years ago, it was energy companies were the big companies, but of course now it's tech companies. And you can see that small and mid cap stocks significantly outperformed. Why was that? The earnings have been great for the large companies, but this bit of outperformance was because last week's rally had a lot to do with expectations for rate cuts. Smaller companies tend to be more sensitive to movements in interest rates. And if it's perceived that the odds of a rate cut are increasing, then the capital would flow. And sure enough, it did. And the better performer was small cap stocks as measured by the S&P 600. International markets, and in particular emerging markets, did well, though China, which is the biggest emerging market, lagged the rest. Bonds caught a bid on those expectations for rate cuts. Let's move into some of the economic data last week. There was a lot of it. It was mixed. So a lot of it was very soft, which is why the expectations for rate cuts increased. Let's start with employment cost index. First quarter employment cost index up more than expected, 1.2%, the biggest gain in a year. That's a difficult number to read if you're the Fed and you're worried about inflation, because employment costs are a big driver of product costs, which of course are a driver of CPI or core PCE or inflation. Third straight month in a row, up 4.4% on a year-over-year basis. So not particularly good news. We also had some new minimum wage hike laws go into effect here in California, which obviously California, 40 million people out of 350 represents a large percentage of the population of the country. Inflationary data from housing price increases is still very much with us. FHFA house prices showed a gain of 1.2% in February. The estimate was only 0.2%, and house prices by this metric are up 7% on a year-over-year basis. The same thing pretty much from Case-Shiller, expected to go up 0.1%, up 0.6%, and they're up about 7.25% on a year-over-year basis. Higher housing prices force higher rents, owner's equivalent rent. All of this goes into the inflation data, none of which is good for a situation where we're trying to get that core PCE down below 3%. The tool that the Fed is using, of course, is the interest rates and the balance sheet. But they're doing that in the face of large fiscal deficits, which we've talked about for the last couple of weeks, but I'm harping on it, I know. Moving on, Chicago PMI fell from 41.4, which is contraction, to pretty significant contraction, quite frankly, 37.9, way below the expectations of 45. New orders in significant contraction, production significant contraction, employment significant contraction, at the same time that prices paid rose. Now, this is just a regional indicator. It's just Chicago, and it is just 1 month. But this is what you call ultimately could be, if it filtered out into, say, the the national ISMs for manufacturing, or the PMIs for manufacturing, you could see that be a problem. You can have things slow down, but if things slow down while prices go up, that's the definition of stagflation. I am not saying we are in stagflation by any stretch. Employment numbers are still good, et cetera, et cetera. But this is not a good situation if it persists or if it expands further around in some of the other reports, something we'll be looking at very, very closely. We then got a report from the Conference Board, their measure of consumer confidence. You can see that's been sort of lowering, and it's lowered some more, fell from 103.1 to 97, well below the estimate of 104. Present situation fell, and expectations fell kind of a lot. So as the economy sort of moderates, even though we have a strong jobs market, even though we have strong earnings, the inflationary component, the higher energy prices, the higher food prices, and the higher rents and things like that are really starting to take their toll on consumer confidence. We then got both manufacturing readings, the final readings for April, S&P Global, which is the old Markit, and then the ISM. S&P Global, the old Markit, said it fell from 51.9 to 50. So they say that manufacturing did expand, but just barely. It's right at that line of delineation on a national basis. And the ISM folks said, well, it actually declined, came in at 49.2. The estimate there was 50. New orders fell into contraction. Production increased, but at a slower pace. And employment fell, but at a slower pace. Then we move on to services from S&P Global, which is, again, the old Markit, fell from 51.7 to 51.3 and was ahead of expectations. So services, 70% of the economy, expanded, while manufacturing, services 85%, manufacturing's 15%, was flat to down. Then you look at ISM services, just another competitive metric, and this was a big surprise. Fell to 49.4. The estimate was it was going to go up, and this is the first negative. Well, we had one reading in about the summer of 22, and then negative readings during the recession. So to see that below 50 was kind of a startle to the market, a little bit of a surprise. It's 1 month that could turn around. New orders were still positive. Business activity was still positive. Employment, though, not so good. So when you get sort of 4 or 5 not so good readings in a week, then all of a sudden the Fed futures market says, well, maybe they'll cut rates to try to stimulate. But how are they going to cut rates if they don't see core PCE inflation at target of 2%, or at least lower than it is with the signs of slowing? So it's putting the Fed in a difficult situation. Moving on to construction spending for the month of March, fell 0.2%, was expected to go up 0.3%. So that wasn't particularly positive. What remains positive is jobs. Weekly initial claims for unemployment unchanged at 208,000. I told you last week, we were at, last time we were in the 200,000s was really the 1960s. In the 1960s, the labor market was half the size that it is now. The population was a little more than half the size it is now. So if you take this 208,000 as a percentage of the workforce, it's really significantly lower and an all-time low, which is great because it means that if things are slowing down, they're not slowing down much until you start to see layoffs. So we're pleased, obviously, with that. We also got the job openings report, or JOLTS, which peaked at 12 million about 2 years ago, fell from 8.8 to 8.5 million. That was below expectations, but that still far exceeds the number of unemployed or underemployed or partially employed people in the workforce. But as you can see, we're now getting closer to the pre-COVID level, which would be the high sevens. So if we were to get down around 8 million, I would say we'd be back to that level we were prior to COVID. We then got the two big jobs reports. So every month there are two. There's the Bureau of Labor Statistics, which is the official government report, which uses its own statistical model. And then the payroll company, ADP, using data from its own business, puts out a report called the ADP Employment Report. And the ADP Employment Report said that, hey, we beat expectations. We added 192,000, but we revised up March from 184 to 208. Services in April added 145,000, and goods producing jobs added 47,000. So that was kind of the first report. We always get that one first. We usually get that on Wednesday, and then we get the big one on Friday. That's the non-farm payrolls report. They were estimating 240. We added 175, but we also revised March up a little bit, 303 to 315. Not a big deal. But because it wasn't one of these big beats, which is what we've been having month after month after month, it was more of a sign that there was cooling in the market, in the labor market, cooling in demand overall, and again, brought the odds of a rate cut this year up a little bit, the Fed funds futures market last week, and that's one of the reasons the market rallied. Productivity and unit labor costs, first quarter productivity up 0.3. Labor costs gained 4.7. So this labor cost thing is continuing to be a problem, but less of a problem. Remember, we were at 6% a couple of years ago, but still, real wages are increasing. That's good. That's good for all of us. It's good for the consumer. It's good for the quality of life. It's the great promise of capitalism to see that. But we're not doing it at a time of price stability. And the lack of price stability seems to me be more driven by the perpetual fiscal deficit and the excessive borrowing that's required to manage that fiscal deficit than it is by the economic activity of businesses trying to meet the needs of consumers, and in doing so, paying their employees more and increasing their quality and standard of life. There's absolutely nothing wrong with that. It's a great thing. Average hourly earnings are the result. They are going up again. They rose 0.2%. And these are real earnings, not nominal. So this is net of inflation, and 3.9% increase in the average hourly earnings rate is down from what it had been at some of the peak, but it's still a pretty sizable number. Auto sales rose to about 15.7 million annualized pace, up from 15.5, right in line with expectations. Still below what we were prior to the pandemic, where we were in that 17 million range. The big part of that is higher interest rates that buyers would have to contend with. The other part of that is a cost of maintaining vehicles and registration and insurance, and all of the things that have gone up are causing consumers to say, maybe I can use this car another 3 years, another 5 years, et cetera. And maybe it's just also the cost of food and shelter and gas that's driving them to do things like keep their cars longer than they might otherwise would have. Factory orders in March up 1.6, right along with expectations, backing out aircraft, essentially transportation items. Beat estimate was 0.2, came in at 0.5. That was pretty solid. Earnings continue great. We're just about wrapped up. 400 or 80% of the companies have reported. 316 of those have beat. The average earnings surprise is single digits, 8.6% or so. You can see there, consumer discretionary, wow, tells you how strong the consumer is. That's coming from the strong labor market. 18% earnings beat on consumer discretionary. Staples are solid. Industrials. Finding something that's not is only energy. That's sort of good because energy profits can really fluctuate with prices. So that's better. And real estate, obviously, the leveraged impact of real estate investments or REITs, that's hurting their bottom line, but they're still able to eke out some earnings gains with 20 out of 27 reported companies beating estimates. Where's really the earnings coming from? This is no surprise to anybody who follows us. There's 5 companies out of the Magnificent Seven that are driving this. NVIDIA, Amazon, Meta, otherwise known as Facebook, Alphabet, otherwise known as Google, and Microsoft. Year-over-year earnings growth for the first calendar quarter, as reported there, is running about 60%. If you take the rest of the S&P 500, it's negative, and if you blend the 5 with the rest of them, it's just barely above positive. So interesting stuff. Keep an eye on it, and it's one of the reasons we are overweight by owning, of course, the S&P 500, but we also own the NASDAQ. So we had a Fed meeting last week, and we were all very interested to know what would Chairman Powell say, what would happen in the futures market, and if the Fed is truly as independent as it should be, and as it is, and as it claims to be, then I don't think there's going to be a rate cut this year. But I have to be realistic, and I'm going to give you a couple reasons why it's likely that there still may be a rate cut. First of all, the slowing data, I don't think really, the slowing data on manufacturing or et cetera doesn't really necessitate a rate cut. Loss of jobs would necessitate a rate cut. But what will the Fed do if we get the loss of jobs and inflation remains elevated above its target of a core PCE at 2%? This week, the Fed did nothing. Last week, rather, did nothing on interest rates. 5.5% is the upper target. The highest level, it's been there for some time, but it's the highest in more than 20 years. And then some quotes from the chairman in his speech after the meeting at his press conference. So far this year, the data have not given us that greater confidence, in particular, that rate cuts are appropriate. This is the chairman saying rate cuts are not appropriate, maintaining his independence, doing what I think he's supposed to do. He went on and he said readings on inflation have come in above expectations. Yes, they have. It is likely that gaining such greater confidence will take longer than expected. In other words, we won't get confidence on inflation right away. It's going to take more time, and only then can we cut rates. And it's unlikely that the Fed's next move would be to raise rates. Okay, so he's saying we're kind of capped here for a while, but why did the Fed funds futures market suddenly price in an increase in the odds of a September cut? One of the reasons is it's right before the election. Maybe. Okay. The other reason is that they reduced the rate at which their balance sheet is going to run off in the future. The Fed, during the COVID crisis and other crises, buys bonds and buys mortgage-backed securities, which are similar to bonds. They package up your mortgages, our mortgages. And then when times are doing well, like they have been, they're supposed to let that balance sheet run off. So they increase the money supply to stimulate the economy in the recession. They let the balance sheet, as the securities mature, or they could potentially sell some, that decreases the money supply to prevent the inflationary pressure. But the Fed also announced that we will slow the rate of decreasing the money supply. I know that's complicated. Think of it as a baby rate cut. And that's what sent risk assets running higher last week. The other reason I think it's likely that they could cut rates is even though the Fed is independent, even though the Fed's mandate under law is not to worry about the balance sheet of the United States Treasury, or the income statement of the United States Treasury, I should say, their job is to maintain price stability, be a lender of last resort, and foster full employment. And they are independent of the Treasury and independent of the executive branch, independent of the legislative branch. But take a look at this chart. I think we found, where did we find that? I think we found this on the Daily Shot, which is a great thing. You can subscribe, it's free. And they were sourcing it from B of A and Haver. So all credit due to who this came from, but they point out that U.S. Treasury interest payments for the last 12 months, the interest on the debt has now exceeded $1 trillion. Now, if rates are not cut by April of 25, a year from now, the trailing 12 months interest expense of the United States Treasury will rise by 70%. It will go to $1.7 trillion. If they cut rates 6 times, yes, 6 times, 1.2 trillion, still a 20% increase. So for this reason, would the Fed sort of ignore its independence? Would it ignore its mandate? Are they just hoping that the Congress will do something about the spending and the deficit, or what? But either way, interest expense goes up pretty unfathomable rate. And if they don't cut rates, we're talking about another $700 billion in interest expense next year that the United States Treasury will have to pay on its debt securities, T-bills. Those are the things that sit in your money market accounts, your government bond funds. Okay, moving on. Not a lot of economic data this week, complete opposite of last week, which is, of course, the first week of the month. Nothing today of significance. Consumer credit on Tuesday, weekly claims on Thursday, and consumer sentiment on Friday. And we're just about wrapped up with earnings season. This would be a good weekend for somebody like me to go on vacation. Big earnings this week, not really. S&P 500 names, Uber and Disney could be possible market movers. But that's really it. Thanks for coming. Thanks for listening, for tuning in. I always invite, questions, comments, shoot me an email, whatever you want to do. We can listen. I guess we're getting the most views now on the YouTube channel. Please subscribe and like and thumbs up. But we're also available audio only on all of the other ones you see listed here. Thanks, everybody. I'll be back to you again in 1 week.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.